Everybody, today is Saturday. It's the 25th of July, 2020. Let's take a look at the market from this week. First, we'll start with the numbers. We did lose a little bit of ground. S&P down a 0.5%, Nasdaq down close to 2%, and the biotechs, which had been really strong lately, lost 5.5%. So let's take a look at these charts here and make some sense of it. The S&P 500 is still clearly in a longer-term uptrend. We're above a rising 20 and 50-day moving average, also above that 200-day moving average. I think the trend line that makes most sense right now comes in right around with that 50-day moving average. The 30-minute time frame, you can see we are below the declining 5-day moving average. So I'm looking at this next week ahead as cautious, meaning that we want to, in terms of buying the S&P 500, I think as long as it's below 323, you don't want to add new positions. It's possible we could retest the volume weighted average price from that May 29th low. That has been important support here a couple of times. So with this market, the SPY, below the declining 5-day moving average, we want to look at it again as guilty till proven innocent, just on the shorter term time frame within a longer term uptrend. The Nasdaq finally broke this pattern, and I didn't want it to happen, but it's just been such a strong pattern of these higher highs and higher lows for several months since that March low. That pattern has been broken. We made a lower low on the intermediate term time frame. Now the longer term time frame is still higher. What this tells me is not that we're going to reverse and crash, but instead that it's likely this market needs to kind of slow its pace down, consolidate a little bit, at least through time, if not further price correction. And if we were to see further price correction, I think that the 50-day moving average sure makes a lot of sense from this point. But right now we're fine. We found the buyers on Friday at the volume weighted average price from this gap lower. If we back it out to a 65-minute time frame, these are some of the levels that we've been watching over the last few months. And perhaps we get down into that 243-ish area would be, I think, the lowest we would likely see this market go this week. But more likely, I think the 50-day moving average if we see further weakness. And obviously the reversal in Tesla after earnings has somewhat to do with that. This market's still holding, the Tesla that is still holding that rising 20-day moving average on a closing basis. So incredible strength despite the fact that you can look at it and get scared that it's down from 1700 to 1400, but the fact is it's in a super strong uptrend. The Russell 2000, as we know, broke this consolidation of this triangle that we've been looking at that has been forming over the last month or so. It broke above that 2 weeks ago, and also the 200-day moving average. Look how it continues to close above that 200-day moving average. That's, of course, this black line right here. So when we look to a 30-minute time frame, we are below the 5-day moving average. The most important level we want to see this market hold this week is 144.5 to 145. If it continues to hold that, it's this prior band of resistance as well as the volume weighted average price from that July low that we've seen so far. And that tells me that if it can hold that in the 20-day moving average, it seems that this market should be able to continue to at least chug higher. I don't think it's taking off here. It's been a large underperformer relative to the other markets, but right now its chart is maybe a little bit stronger for the intermediate term perspective. Semiconductors also still in a strong uptrend. These guys have not broken that pattern. We see this low, we see a higher low, we see this high, and we see a higher high. So we still have a pattern of higher highs and higher lows in here. The most important level, one, we're at the rising 20-day moving average, and the second most important level will continue to be that 154 level. As long as we're above that, I certainly wouldn't be looking to short this market. I think it's, if you're trying to short these types of markets, you're clearly fighting the longer term momentum, and the volume weighted average price from that June 29th low once again was important this week. Now, if it breaks that, then of course the bigger level is down at near 154. I don't see big downside for this market. So again, the short side is difficult. Now, the biotechs, which have, as we know, been up at all-time highs here recently, This is the monthly chart we were looking at. They broke that level, so going down to a weekly time frame, there's that 125 area. And on the weekly time frame, we see a nice pattern of higher highs and higher lows. On the daily time frame, what do we see? We undercut this low ever so slightly. I think it's most likely a trap. If you're looking to short this market, clearly, you're late. From 146 to 136 and just slightly undercutting this low at the rising 50-day moving average tells me that it's more likely to bounce from here and then maybe do something like this before another leg lower. But looking to the 30-minute time frame, we are below that June low volume weighted average price, so we have to be a little bit careful in here. But I certainly, again, would not want to be shorting it. I think that this slightly lower low is more likely a trap, and we see a rally up before it becomes apparent that we might be looking at some deeper profit taking in the biotechs. But for now, I think, again, where has it come from? It's just dropped from 146 to 136. You just don't want to be shorting after a large drop like that, especially when we have a rising 50-day moving average. Financials, as we know, this group has a little bit of room to outperform, I think, going forward. We, of course, saw that failed move 2 weeks ago. From that failed move, we've seen this continued faster move higher. It is slowing down a little bit, but it continues to hold above the volume weighted average price from the prior peak, which occurred right at that declining 200-day moving average. So underneath the surface, we see a rising 20 and 50-day moving average. We have that 200-day moving average overhead up at 26, which is a pretty good distance away. On the 30-minute time frame, 2375, 2390, that I think is the key level we want to see continue to hold. If it holds above that, then we can look for this market to continue to show a little bit of outperformance. It is one of the few that is above the rising 5-day moving average. In fact, it is the only one of these groups that we look at that is above the rising 5-day moving average. Apple got a little bit of profit taking this week too. It is below a declining 5-day moving average. Looking to the daily time frame, I think it's highly likely that we slightly undercut the 350 level before a more significant bounce occurs. But if it doesn't do that, it shows that there are still dip buyers out there who are aggressive. But for now, as far as adding a new position in Apple, to me it doesn't make sense at all, not with a declining 5-day moving average. That'll do it for now. Have a good rest of the weekend.